Good morning, ma'am. Good morning, classmate. Accounting 3B. Effective interest method, market price of bonds. Technical knowledge to understand the effective interest method of amortizing bond premium and bond discount. To distinguish effective rate and nominal rate of interest. To know the computation of the market price or issue price of bond payable. The two kinds of interest rate is nominal rate and interest rate. Okay, the nominal rate is the coupon or the stated rate. This is the actual amount of the interest paid by the bond issue or the rate of interest because adjustment for inflation or for interest rate as stated without adjustment for the full effect of compounding. The interest rate is the field or market rate. For example, if an individual takes on 10,000 pesos from the bank and the loan agreement is stipulated that the interest rate on the loan is 15%. This means that the borrower will have to pay the bank the original amount of 10,000 plus the interest of 15%, which equivalent to 1,500, so that the total amount will he or she pay 11,500. Effective rate is the rate that exactly discount estimated cash future payment through the expected life of the bond payable. Effective interest method. Under the effective method, the effective interest expenses is determined by multiplying the effective rate by the carrying amount of bonds. Premium amortization is computed. For example, the nominal interest is 100,000 and the face amount is 15%, so that the premium amount is 15,000 per year. Discount amortization is a process through which bond discount written off over the life of the bond. For example, bond payable is 10 million and bond discount is 147,409 and net bond payable is 9,852,591. For example, the total bond liability equals 10 million, the product of 10,000 number of bond and the bond face value of 1,000 because actual cash proceeds are 9,852,591. The bank divide by this amount and balancing figure is attributable to the bond discount. Bond discount is an contract account to the bond payable account on the balance sheet. Okay, bond carrying value book value on the balance sheet equals the bond face value minus the bond discount. That's 9,852,591. Effective amortization of discount. On January 1, 2020, an entity issued 2 years 8% bonds with face amount of 1 million for 9,064,540, a price which will yield 10% effective in interest cost per year. Interest is payable semi-annually on June 30 and December. Interest paid. Face amount of semi-annual nominal rate of 4% of 440,000. Interest expense rate to the cost of borrowing money. It is the price that a lender change a borrower for the use of money, the lender money. On the income statement, interest expenses can represent the cost of borrowing money from the bank, bond of debtor, and others. Discount amortization. Interest expense minus interest paid is the process through which bond discount written off over the life of the bond. There are two primary methods of bond: amortization straight line method and effective interest rate method. Carrying amount. also known as the carrying value, is the cost of an asset plus accumulated expiration. The carrying amount is usually not included on the balance sheet, as it must be calculated and the initial acquisition of asset. The carrying value of that asset is the original cost of it purchased. Here's an example formula. Carrying amount. Effective amortization of premium is done by reducing the balance of the premium on bonds payable account by the difference between two terms of period. Schedule of amortization. Market price or issue price of bond payable is equal to percent of the principal bond liability plus the present value of future interest payment using the effective of market rate of interest. Okay, computation of present value of the bond. Effective interest method bond issue provide that transaction costs that are directly attributed to the issue of financial liability shall be included in the measurement of the financial liability. That's all my report, ma'am. Thank you.